Now, what was interesting is during my private equity days, we kind of had a twofold approach, which would oftentimes blend together. My private equity firm had really three sources or three buckets of capital. It had our balance sheet capital. It had capital that it could raise through our own high net worth investors who were in essence our friends and family. And then we would raise the preponderance of our capital through large institutional sources, kind of the household names of institutional private equity. And so when we would go and do a deal, we would oftentimes form a joint venture. That was our typical approach, joint venture with a large private equity group. So for example, we might be going and acquiring a $100 million property. Well, that $100 million property is going to need $30 to $40 million worth of equity. So in a typical 90-10 JV structure, if it's a $40 million equity check, the institutional JV is going to come in and provide $36 million of that equity, and then look to the sponsor to provide $4 million. It's within that $4 million that they would then look at our firm and say, look, your firm doesn't have to provide all of the $4 million. We know that's still a pretty big check for a regional operator. Why don't you guys provide 1 to 2 and then go syndicate 2 to 3 from your friends and family? And so that's exactly what we would do on a one-off basis. We would put together then, the pitch book, show it to the investors. Hey, we're going to go buy this office tower with this institution. Here's the business plan. Here's the underwritten returns. Would you like to come participate? So it was interesting. So in essence, we would be both in a JV and but then also syndicate that on our side simultaneously.